Hello and welcome to my channel. If you're interested in learning about hedge funds in 3 minutes, then you've clicked on the right video. Now, let's jump into it. So, what is a hedge fund? A hedge fund takes money from investors and invests in aggressive and complex strategies in order to generate very high profits. They are more willing to take risks than other investments, such as mutual funds or exchange-traded funds. If you're thinking, well, I want a piece of this, then you may be disappointed to hear that hedge funds don't actually accept money from just anyone, and typically charge very high fees. They can potentially make very high profits, as they are less regulated than other funds. On the flip side, this also means the potential for larger losses. Hedge funds use risky strategies including short selling and leverage. Leverage essentially means borrowing money, and short selling is betting that a stock will drop in price. Hedge funds have a bad name due to recent cases of insider trading and market manipulation. You may have heard of the Bernie Madoff and Galleon Group scandals. Let me know in the comments section if you would like a video on these. So, who can invest in hedge funds? Only the very wealthy and institutional clients, such as pension funds and foundations. Individuals must have a net worth of at least $1 million or annual income over $200,000. An average Joe wouldn't be able to even get their foot in the door. How do hedge funds make money? Well, they usually charge a standard management fee of 2% and a performance fee of 20%. This is known as 2 and 20. An investor only needs to pay a performance fee if the fund makes a profit, which motivates the fund to make riskier investments. If a hedge fund makes a loss, investors still need to pay management fees. You may be thinking, well, wouldn't an investor just sell the fund to cut their losses short? But another downside of hedge funds is that investors can't typically take their money out immediately. There may be lockup periods or only certain times of the year that investors can take their money out. So investors don't just have a loser in their hands, but they also have the pleasure of paying high fees to continue holding this fund in their portfolio. Let's go through a fees example together. So, let's assume a hedge fund is $100 million and charges a 10% management fee and a 20% performance fee. If the hedge fund generates a profit of 10% in a year, how much money will the fund make in fees? The answer is $4 million. Here's the breakdown. 2% of $100 million gives us $2 million in management fees. A profit of 10% of $100 million is $10 million. If we multiply $10 million by 20%, this gives us $2 million in performance fees. The answer is therefore $4 million in fees in total. Did you get this correct? Thanks for watching. If you found this video helpful, please hit the like button and subscribe for more videos. Feel free to leave questions and feedback in the comments section.